Bismillahirrahmanirrahim. Assalamu alaikum. I am Syed Akif Shah, lecturer finance at Institute of Business Studies, Kohat University of Science and Technology. The title of this course is Business Finance, and the course code for this subject is BS 151. This is lecture number 25, and the topic for today's discussion is financial ratios from balance sheet and their uses. The outline of this lecture consists of the discussion regarding what are financial ratios, secondly, uses of balance sheet ratios, and third, the internal versus external industry comparison. External means the industry comparison of financial ratio for analysis purposes. So what are financial ratios and what are their uses? A financial ratio is an index that relates two accounting numbers and is obtained by dividing one number by the other, which we will see shortly in a practical example. So what is a financial ratio? It is basically an index which can be calculated by dividing one number from a balance sheet with another number. Like for example, divide current assets by current liabilities. Now both the numerics belong to the same financial statement, and the resultant value will have certain outcome, and we can analyze the resultant value obtained by dividing current asset with current liabilities, and this discussion will be presented to you shortly. What are different types of comparison for such financial ratios and what are their uses? We actually calculate and measure these financial ratios for internal comparison purposes and as well as external comparison purposes. What is internal comparison? Like we can compare the current ratio, which can be obtained by dividing current asset with current liability within the company with itself. Like the current ratio of 2007 can be compared with the current ratio of 2006, 5, 4 and later on in the subsequent year as well. When we talk about external comparison, we are inclined towards the comparison of a particular financial ratio with a similar nature company which is operating in the same industry or sector. When we talk about the industry and sector, we mean that sometimes we listen that this factor is related with cement industry. When an industry word came before you, then it must be clear in your mind that it consists of all similar nature company. It means all the companies manufacturing cement in the particular region have been referred by the term industry or sector. Let's take another example. When we refer to the banking sector or a banking industry, it means that we are referring to all the banks available are operating in that particular economy or region. So basically we can compare these financial ratios internally during the number of years or time period, and as well as we can compare these financial ratios externally with the similar nature companies. So what is this external comparison and sources of industry? Now the industry phenomenon is clear to you. This involves comparing ratios of one firm with those of similar firms or with industry averages. So there could be two types of external comparison. We can compare our company's financial ratios with another company which is in similar nature, and as well as we can compare the overall industry averages. Like there are many independent financial companies, for example, Risk Management Association, Dun & Bradstreet, and Almanac of the Business and Industrial Financial Ratios. There could be Standard & Poor and Moody and Fitch as well, which normally presents or give us the industry benchmark or averages pertaining to many companies operating in the specific industries. So we can compare our company's financial ratios with the industry averages as well. And the point of focus is the similarity is important, as one should compare apples with apple. This example means that the cement industries companies must be compared with the other cement companies, and cement company must not be compared with an IT or high-tech company or any other services sector like banking and insurance companies. For banking companies comparison, one should look at the similar nature company which belongs to the banking or financial sector. And when we are comparing a manufacturing company, let's say cement or textile, then we should compare the textile company with the textile industry or sector. This is the balance sheet what we have covered in my previous lecture and explained to you that order of liquidity should be followed. Left hand side actually tells you about the assets, economic resources owned by the business, and the right hand side of the balance sheet tells you about the sources of financing from where you have actually financed your company and then purchased these different kinds of assets. So now as we are discussing about the balance sheet of financial ratios, so therefore we are required to obtain different data from assets and as well as liability and owner equity to come up with different financial ratios pertaining to this company, which is Basket Wonder. This balance sheet belongs to Basket Wonder, and the Basket Wonder balance sheet is for a specific date, which is December 31st 2007. And now we will try to calculate different financial ratios shortly by picking up and obtaining data from this balance sheet. Let us discuss the first balance sheet ratio. These all ratios are related with the balance sheet, and the first ratio discusses about the liquidity. What is liquidity? If we define liquidity, then in financial management or a business finance course, we usually define liquidity as the financial position of a company to pay out its debt obligation in due time. Then we can say that the company is having in a liquidity position. This liquidity ratio can also explain that what portion of our current liabilities can be financed with the help of current assets. And normally, the larger number of current assets available in a particular company, the highly liquid assets they might have, and so that they can pay out their short-term liabilities in due time. So what does this current ratio tell us? The first ratio to know about the liquidity of the company is to calculate the current ratio. What is current ratio? It actually shows us a firm's ability to cover its current liability with its current assets. The formula to calculate current ratio is to divide current asset by current liability. Since this ratio belongs to balance sheet, therefore we can obtain the current assets and current liability data from the given balance sheet as this has been mentioned before you. This was the amount of our current asset, which is $1,195, and the current liability of Basket Wonder is $500. So we can simply obtain data from our balance sheet, and hence we can plug it into given formula, which is over here. After plugging the data, we have come up with 2.39 current ratio. When the current ratio is greater than 1, then it is a good sign. However, we need to compare this current ratio with the industry, because excessively availability of current asset is not even good for a firm's health. So let's compare it. We can have two types of comparison. Basket Wonder comparison with itself. The current ratio for year 2007 is 2.39, and the previous year current ratio was 2.26. So we can see that there is a slight improvement in the current ratio. Similarly, in 2005, the current ratio of Basket Wonder was 1.91. So if we would like to compare the current ratio of Basket Wonder of 2005 with 2007, then we can see that there is a huge improvement in the current ratio, which is a good sign. Now let's compare externally the Basket Wonder with the industry average. Industry average tells us about the mean value of the current ratio of all the companies operating in this particular industry. So we can see that the Basket Wonder is performing well above the industry average. Ratio is stronger than the industry average. So we can see that in each previous year, the Basket Wonder was performing well than the industry average. However, it was not performing better than the industry average in 2005. So this is the way we can compare the financial ratio internally within the company with itself, and as well as with the industry benchmark. Let us discuss another balance sheet ratio, which is named as the asset test or quick ratio. And the formula for calculating quick or asset test ratio is to once again divide current assets by current liabilities, but you need to focus on the inventory section of current assets. Like here, you are required to subtract the inventory from current assets so that we can have the most or highly liquid assets in the accumulation of current assets. This ratio actually tells you about the high level of liquidity inside the company. What does this show? This ratio, liquidity ratio, which is asset test ratio, it shows a firm's ability to meet current liabilities with its most liquid asset. As we know that inventory is not highly liquid asset because it takes time to be transformed into finished good and then to be sold out. Therefore, we have excluded the inventory in our calculation of asset test ratio. Now, as previously, we can get the current asset data from the given balance sheet and the inventory data from the same December 31st, 2007 balance sheet. Let's counter check whether we have plugged this data correctly or not. So we have realized that we have correctly selected the current asset data and as well as the inventory data from the balance sheet. Current asset minus inventory and then whole divided by current liability. Let me remove these inks. We have correctly selected the current assets, inventory and the current liability data and then plug it over here in this formula, and we have realized that the most liquid ratio, which is asset test ratio or quick ratio, is 1. Normally one-on-one relationship is acceptable in different companies. However, in order to have the best comparison, we need to check it out with industry benchmark. Let's compare the Basket Wonder with the industry. As we can see, first of all, let's compare the Basket Wonder's asset test ratio with itself. In year 2005, the asset test ratio was well above 1. When the asset test ratio or quick ratio is well above 1, we can infer that the company's liquidity position is well and quite okay. But when the value of asset test ratio is below 1, it is a danger zone and the creditors will not sanction any type of loan to such company later on. So we can see that in year 2000 the quick ratio was 1.11 and there is slight reduction or decrease in the quick ratio, which is not a good sign, and this trend has continued in 2007 as well. So we can see that there could be a potential significant influence of inventories, or there could be a potential problem with the number of inventory the Basket Wonder is possessing, because after the deduction of inventories from the current assets, our quick ratio is not showing a favorable result. Another way around, we can also compare the Basket Wonder's asset test ratio or quick ratio with the industry, which is the mean, which industries measure or benchmarks normally tell us about the average quick ratios of different companies operating in this same industry. So we can see that in year 2005, the industry benchmark for asset test ratio was 1.25, which is quite larger than the basket wonder ratio. And similarly, it keep on up to 1.25 in 2007. When we compare basket wonders asset test ratio of 2007 with the industry average, we can infer that the company which is basket wonder is not performing well on asset test ratio, and there could be a potential liquidity problem in 2007 when the liabilities come due. Let's summarize the two most important liquidity ratios. We have taken basket wonder as our sample company and then selected the industry averages as well. The current ratio of basket wonder was performing well than the industry. However, the asset test ratio has poorly performed in comparison to the benchmark industry. It means that the basket wonder is having some potential problem in the inventory section which they must improve. So final inference is a stronger current ratio and a weak asset test ratio indicates a potential problem in the inventory accounts of basket wonder. And this analysis helps the basket wonder internal management and top management to focus on the inventories and then to improve the inventory account as per the benchmark of industry. Let's move ahead towards another important financial leverage ratio. And the financial leverage ratio, once again, the data will be obtained from the same balance sheet. And this ratio is known as debt to equity ratio. And the formula to calculate debt to equity ratio is to divide total debt of the company in that particular year by the total amount of shareholders' equity. And what does this ratio tell us? It shows the extent to which the firm is financed by debt financing. Usually companies are financed from two main sources. One is known as debt financing and another one is known as equity financing. Debt financing is basically a loan to a company, and this loan requires the company to pay out fixed amount of interest each year. Whereas the equity financing comes from the issuance of shares to the general public, and there is no fixed interest obligation on share capital. Rather, there is profit and loss sharing between the company and the shareholders. So this is the formula to calculate the debt to equity portion in our company. Once again, we need to go to the balance sheet of basket wonder dated December 31st, 2007. And from that balance sheet, we have selected or picked up the total debt value, which is 1030, and the total shareholder equity, which is 1139. Let's counter check by going back. Either we have plugged this data correctly or not. So the total debt instrument is the long-term liabilities plus the short-term liabilities. The accumulation of them comprises of 1030, which was correctly picked up from this section, and the total equity portion was 1139. So therefore we have correctly picked up the relevant data from the balance sheet and then plug it over here in this debt to equity calculation, and we have come up with the answer by 0.90. Now what does it mean? It means that our total debt instrument are 90% of our shareholders equity. Now let's explain it in another way around. If the shareholder equity or the amount financed from equity portion is $100, then the company has financed the rest of its share with the help of debt instrument by the amount of $90. This ratio tells us about the one-on-one relationship between debt and equity portion in our company. Not only it is important for the financial manager working and operating inside the organization, but such kind of ratio is also important for the creditors who are going to sanction loans to this company, and as well as it is beneficial for the shareholders and the bondholders to know about the ratio of debt to equity in a particular company before they are going to take investing decisions. We can compare this financial leverage ratio of Basket Wonder with itself and as well as with the industry ratio. So we have seen that the Basket Wonder's debt to equity ratio has been improved and increased in the last 3 years. It was 81% with respect to the shareholders' equity in 2005. However, in 2007, debt to equity ratio is 90% or 0.9. Now let us compare the Basket Wonder with the industry in which the Basket Wonder is operating. So these are basically the benchmark or mean values of all the companies operating in the similar nature business. As we have selected the 2007 balance sheet, so let's compare the 2007 debt to equity ratio of Basket Wonder with the industry, and we have seen that the Basket Wonder has performed really well because its debt to equity ratio is exactly same, which is 90% in Basket Wonder, and the industry average is also 90%. It means that the company is performing within the realm and premises of the industry mean. Therefore, we can infer that Basket Wonders is utilizing its debt to equity ratio in the same manner as industry expect or industry demands. Let us discuss another fourth financial leverage ratio, which is known as debt to total asset ratio. The formula to calculate this ratio is to divide total debt by total asset of the company. Once again, this is a balance sheet ratio where we are selecting or picking up both the numerator and denominator from the same balance sheet. And the balance sheet we have selected to analysis this financial ratio is Basket Wonders December 31st, 2007. What does this ratio tell us? It shows, we can see that it shows the percentage of the firm's assets that are supported by debt financing. Let's move back to the balance sheet and see whether we have picked these data correctly or not. So total debt in 2007 of the company is 1030, and the total assets of the company in 2007 are 2169. Let's move back to the balance sheet. So we can see that the total assets data, which is 2169 in the balance sheet, was correctly picked up, and the total debt, which was current liability and the long-term debt, needs to be accumulated, sum these two values, and the total debt of this company is 1030, which was once again correctly picked up. Therefore, we can move forward to the relevant slide and let's analyze the data. So this was the slide we were discussing, debt to total assets, and it shows the percentage of the firm's assets that are supported by debt financing. So after plugging the data, we come up with 0.47. Now what does this mean? It means that our total debt, which we have obtained from multiple sources, has sponsored 47% of our total assets. Now, what does it mean? It means that let's suppose if the company has $100 worth of assets. Then out of this $100 worth of asset, $47 worth of assets were financed from the debt instruments, from bondholders or from any other notes payable or loan obtained from any depository institution. So if the total assets in the company are 100, then this out of 100 assets, $47 of worth assets were sponsored by or financed by the debt instruments, and rest of the 53% were financed by equity financing. Now let us compare the debt to total asset ratio of Basket Wonder with itself and then with the industry. So we can see that in the couple of previous years, in 2005, the debt to total asset ratio was 45%, and then the company has increased the debt to total asset ratio 47%, and it will remain as it is in 2007. Now we cannot infer our conclusion either the Basket Wonder is performing well or it is performing poor on debt to total asset ratio. We can only infer this conclusion by comparing it externally with the industry averages. So we have realized that the Basket Wonder is exactly performing on debt to total asset as the industry mean average value is. It means that the debt to total asset of Basket Wonder, which is 47% in 2007, is exactly the same with the industry mean averages. So therefore we can infer our conclusion that the company Basket Wonder is performing exceptionally well on debt to total asset ratio, which is exactly in match to the industry benchmark. So this was all about financial ratios related with balance sheet, which are really important for internal financial statement user like financial manager, and as well as for the external users, which could be bondholders and the shareholders who are looking to invest in this particular company. The financial ratios and financial statement analysis is really crucial for internal and as well as external users. Thank you very much for listening to this lecture. If you have any confusion on any financial ratio, you can ask question on KCMS and as well as via email. Thank you very much once again. Good luck for the day. Allah Hafiz.